Hi, I'm Joly. This is my channel, China's Playbook. Today, I raise a constantly contested yet unavoidable topic. Is China still investable? If you tune into the mainstream media, the narrative is completely frozen. Everyone's shouting about debt cycles, decoupling, and regulatory black swans. The general consensus among Western LPs seems to be too much risk. Let's sit on our hands. But if you look at where the smart money is actually looking right now, a massive silent divergence is happening. While retail investors are panicking over headline noise, sophisticated allocators are fighting a different battle. It's classic financial FOMO. And the dilemma is simple. If you are still running the old China playbook, you're going to lose. The golden era of taking a massive consumer app, scaling it with local internet traffic, and chasing a quick Nasdaq IPO exit? That play is dead. The tech bro bubble has officially popped. But if you cut through the noise and look at the real signals, how global manufacturing is scaling, where the deep tech life cycles are heading, and how hardware supply chains are shifting, the real thesis emerges. China is no longer a passive growth proxy for your portfolio. It has flipped into a brutal, highly specialized, pure alpha market. So today, let's drop the political theater. No emotion, just pure venture data. We're going to look at the new macro reality, the industrial modes, and the technology life cycles to answer the only question that matters. Can your portfolio truly afford to bench China? And that is a question I've spent the last 17 years answering from the absolute trenches of the Chinese private markets. I don't view this market through a single narrow lens. My thesis is shaped by a career that covers the entire life cycle of Chinese capital. I built my foundational armor in corporate law at a renowned international law firm, mastering cross-border restructuring and legal risk, before shifting into investment banking at top-tier domestic firms, where I led multi-billion RMB IPOs and corporate buyouts from the front lines. For the past 12 years, I have leveraged this dual legal and financial lenses as a GP professional, originating, executing, and leading portfolio operations for over 60 private equity and venture capital deals across elite international funds. I'm telling you this because managing the lifespan of a deal, from the initial investment memo to the final liquidation event, gives you a completely different view of the market. When you look at China from 6,000 miles away through a news terminal, it's easy to call it uninvestable. But when you are on the ground actively navigating regulations, optimizing entity structures, and engineering exits across the entire deal lifecycle daily, you don't see chaos. You see a highly calculated map of hidden alpha. And that is exactly why I launched this channel. The Western narrative and the on-the-ground reality of Chinese private equity are completely disconnected. My goal here is to bridge that gap. No echo chambers, no political noise, just the institutional-grade frameworks you need to build a real thesis. Question 1. Negative sentiment, but high valuations? The answer is simple. You must throw out your old macro framework. For 20 years, investing in China was a pure beta play. Western capital just poured money into consumer tech, real estate, and delivery platforms. You funded the infrastructure, sat back, and rode a wave of an exploding middle class. What's happening right now is not a typical cyclical downturn. This isn't a recession that you can fix by printing more money. This is a deliberate structural pivot forced by policymakers. The entire economy is being forced much away from debt-driven real estate and into what's called new quality productive forces. Translation: deep tech sovereignty, advanced manufacturing, and self-reliance. As a VC, this creates a massive valuation bifurcation. Yes, the speculative froth in consumer tech and platform plays has been completely wiped out. Those entry multiples are at a 10-year low. But if you look at advanced hardware or AI-native software, we are seeing the exact opposite. These strategic sectors are commanding massive valuation premiums. Why? Because local government-backed guidance funds are stepping in big time. They're flooding these sectors with liquidity, and you have to understand their underwriting calculus. They aren't just chasing a financial IRR. They want industrial footprints, job creation, and tech localization on their home turf. For a global asset allocator, this completely changes how you build your thesis. You can't just buy a broad market index anymore. There's a losing play. The new play is finding specialized local GPs who know how to co-invest alongside these state-backed funds, aligning your capital directly with where the government is forcing the liquidity flywheel to spin. Question 2. Is China truly losing manufacturing? From where we sit on the ground, the answer is an absolute no. There's this incredibly lazy narrative in the West that manufacturing is just cleanly packed up and leaving China for Southeast Asia or Mexico. Sure, low-end, low-margin assembly lines moving out. But high-end, hyper-precise, capital-intensive engineering is actually consolidating inside China. And it's not about cheap labor anymore. That's a 2016 mindset. Today, China's moat is built on massive industrial clustering, an unmatched pool of deep engineering talent, and insane logistical efficiency. Look at new gen EV components or advanced robotics. Chinese tech companies don't just build the final product, they own the entire upstream stack. The material processing, the proprietary automation software, the rapid prototyping loops. It is total vertical integration. And it creates a cost-to-performance ratio that is frankly unfair. This has unlocked the most explosive venture trend of the decade, the Chuhai, or Global Expansion Playbook. The elite VC-backed founders in China today aren't just fighting each other in a crowded domestic market. They are taking this hyper-optimized supply chain weapon and going global. They are capturing massive market share from Western Europe to Latin America. So when you back a top-tier manager in China today, you aren't betting on local Chinese retail consumers. You are backing global market consolidators that are leveraging the world's most powerful manufacturing engine. Betting against that gravity is a very tough position to defend. Question 3. How to cross the deep tech valley? It comes down to the density of the physical ecosystem. A decade ago, China's tech ecosystem was all about business model innovation. Who can build a better food delivery app? Who can scale an e-commerce platform faster? It was a game of pure user aggregation and ad monetization. Today, that game is over. Government policy and capital allocation have forced a hard pivot into deep tech. Commercial space tech, next-gen energy storage, humanoid robotics, and advanced materials. Now, in the life cycle of any deep tech startup, there's a dangerous phase called the scaling gap, the valley of death between a working lab prototype and massive commercial production. This is where most Silicon Valley hardware startups go to die. Scaling physical hardware is incredibly expensive and logistically unforgiving. But this is exactly where China's unfair advantage kicks in. Because of the density of the local industrial ecosystem, a deep tech startup in China can iterate, prototype, and scale physical hardware at a fraction of the cost and at 10 times the speed of any team in the West. What takes 18 months and millions of dollars in Silicon Valley takes 6 weeks in Shenzhen. It's a continuous, rapid feedback loop. As a global investor, you have to realize that China has become the ultimate global crucible for hardware innovation. If your frontier hardware tech can't survive and scale inside the Chinese ecosystem, it's probably not going to be cost competitive on the global stage. If you completely write off China, you aren't just missing regional growth. You are systematically cutting your portfolio off from the world's most efficient engine for scaling physical innovation. You're missing the foundational alpha of the next industrial wave. Question 4. Is China investable? Let's bring it back to the core question. Is China investable? If you're looking for the passive, high beta returns of the internet gold rush, forget it. That China is gone. But if you're an institutional allocator, a family office principal, or a long-term macro strategist looking for fundamentally mispriced assets, globally dominant supply chains, and unprecedented hardware scaling speed, China isn't just investable. It's a strategic necessity for a diversified global portfolio. The game hasn't ended. The playbook just changed. The real discussion now isn't about whether to allocate capital, it's about how to allocate it. Which specific managers actually have the on-the-ground execution power and how to safely leverage new regulatory and structural vehicles. Over the next few episodes, we are dropping the high-level macro talk and getting tactical. We're going to break down the exact fund structures global LPs are using today, like QFLP networks, to move capital cleanly. We're going to dissect how to play alongside local government funds without losing your shit. And we'll map out the exact deep tech verticals that are delivering the highest DPI potential in this new cycle. But before you go, I want to hear your thesis. Are you completely benching China for 2026? Or are you hunting for mispriced alpha alongside these state-backed funds? And if there's a specific operational friction line, like QFLP mechanics or complex cross-border exits, that you want me to dissect in the next video, drop it in the comments below. I read and reply to every institutional inquiry. If you're a fund manager, a family office executive, or an allocator are trying to read the real signals in China's private markets, hit subscribe and let's figure out this new paradigm together. Thanks for watching, and I'll see you in the next report.